In 6 hours, $1,028 trillion was erased from precious metals markets. Gold fell nearly 3%. Silver dropped over 5%. $280 billion was wiped from the silver market cap alone. Silver, which hit a peak above $121 in January, is now down 40%, trading at $74 in Western paper markets. But here's what the mainstream financial press is not telling you. While Western silver trades at $74, physical silver in Shanghai is trading near $100. That is not a typo. Physical metal is commanding a 20% premium over paper prices on the same exchange. Industrial buyers are bypassing futures markets entirely, calling mine CEOs directly and offering 20% premiums to secure physical supply. Samsung has reportedly executed direct deals. The physical market is refusing to accept paper pricing. And in 8 trading days, on February 27th, first notice day arrives for 58,170 open March silver contracts, representing 294 million ounces of paper exposure. That open interest has not rolled. Volatility at current lows is 10 points higher than it was at the $121 peak. The options market is pricing an explosive move. Let me walk you through every data point that explains why this 8-day window, with U.S. markets closed for President Is Day and Shanghai dark, until February 24th, could be the most dangerous moment in the modern silver market. From $121 to $74, the fastest destruction in silver history. Let's start with what just happened. In January, silver traded above $121 per ounce. Today it sits at $74 in Western spot markets. That is a 40% drawdown from the peak in a matter of weeks. In a single 6-hour trading window, $1.28 trillion was erased from precious metals markets globally. Gold fell 3%. Silver fell over 5%. The silver market alone saw $280 billion in market capitalization evaporate. This was not a slow grind lower. This was a violent, coordinated liquidation event that moved through both gold and silver simultaneously with precision timing. For context, the entire global annual silver mine production is approximately 800 million ounces. The paper market just moved the equivalent of years of physical production in hours. And once again, not a single ounce of physical metal changed hands during the crash. What makes this collapse particularly extraordinary is what happened to volatility. 30-day implied volatility is now 10 points higher at 74 than it was when silver was trading at 121. Read that again. The options market is pricing in more uncertainty and more explosive potential movement at current depressed prices than it was pricing at the all-time high. That is not normal market behavior. When an asset crashes 40%, implied volatility typically collapses as well. Fear subsides, the move is over, traders move on. But that's not what's happening here. Convexity is spiking, skew is spiking. The options market is screaming that something violent is coming. It is pricing a coiled spring, not a broken trade. And while all of this paper chaos unfolds in Western markets, the physical market is telling a completely different story. Western paper, $74. Shanghai physical, near $100. Here is the number that should make every serious precious metals investor stop and recalculate everything they think they know about price discovery. Western silver is trading at $74. Shanghai spot silver is trading at 86. Shanghai silver futures are at 88. And physical silver, actual metal that industrial buyers can take delivery of, is trading near 100. That is a $12 to $20 premium depending on which market and which form of physical metal you're pricing. This is not a minor arbitrage opportunity. This is a fundamental breakdown in the pricing mechanism. Physical silver is refusing to accept the price that paper markets are quoting. And it gets more extraordinary. Industrial buyers, the companies that actually need silver for manufacturing solar panels, electric vehicles, semiconductors, defense systems, are bypassing the futures exchanges entirely. CEOs of mining companies are receiving direct phone calls from major industrial buyers, offering 20% premiums above spot to secure physical supply. Samsung has reportedly executed a direct supply deal outside of exchange pricing. This is not speculative money chasing a trade. This is industrial demand that cannot wait for the paper market to correct itself. Think about what this means. If you are a major technology manufacturer and you need silver to keep your production lines running, and the exchange is quoting $74, but you cannot actually get metal at that price, then $74 is a fiction. The real price, the price at which metal actually trades hands, is near 100. The paper market has become decoupled from physical reality. This divergence is not new, but the scale of it is unprecedented. During previous stress periods, we've seen 5 to 10% premiums in Shanghai. We have never seen sustained 20% premiums with industrial buyers bypassing exchanges entirely. That is a market screaming that supply is not available at quoted prices. 8 days until first notice. Day and no mass rollover. March silver open interest currently sits at 58,770 contracts. Each contract represents 5,000 ounces. Multiply that out, and you get 294 million ounces of paper silver exposure still sitting on the COMEX books. And we are now 8 trading days away from first notice day on February 27th, the date when holders of those contracts must decide whether to roll their positions forward, close them out for cash, or stand for physical delivery. Here is what makes this situation so dangerous. There has been no mass rollover yet. Normally, by this point in the delivery cycle, the smart money has already rolled the majority of open interest into the next contract month. Traders who have no intention of taking physical delivery get out early to avoid the chaos of first notice day. But as of right now, 58,170 contracts are still open. That is an unusually elevated number this close to the delivery window. Now let's talk about historical delivery rates. On average, only about 5% of open interest ever stands for physical delivery in the silver market. The paper system functions because the vast majority of participants are speculators who never want the metal. They just want price exposure. But in recent delivery cycles, we have seen delivery rates climb to 10, 12, even 13%. That is more than double the historical norm. Run the math on the current situation. If 5% of 58,670 contracts stand for delivery, that's roughly 15 million ounces. Manageable. But if we see a 10% delivery rate, which is now the recent historical trend, we're looking at 29 million ounces of demand. At 15%, it's 44 million ounces. At 20%, which would be extraordinary but not impossible, given the current physical premium environment, it's 59 million ounces. COMEX registered silver inventory currently sits at approximately 90 million ounces. So even at elevated but not catastrophic delivery rates, you are looking at a significant draw on available physical supply. And if industrial buyers, who are already paying 20% premiums in the physical market, decide they want COMEX metal at 74, or instead, the exchange could face a genuine inventory crisis. The clock is ticking. 8 trading days. 294 million ounces of paper exposure. A 20% physical premium, and no mass rollover yet. What makes this 8-day window even more extraordinary is that 3 critical dates are converging in rapid succession, each one capable of creating its own volatility spike. And all 3 are hitting within a single week. February 20th. SLV options expiry. The iShares. Silver Trust, SLV, is the largest silver ETF in the world. When its options expire, large positions must be unwound or rolled, and that creates pressure on the underlying ETF shares, and by extension, on physical silver demand. Options expiry dates are historically volatile for silver because they force large players to either commit to positions or exit them entirely. February 24th. Silver American options. Expiry plus. Shanghai reopens. This is the big one. American-style silver options expire on the 24th, which means any in-the-money positions will be exercised into futures contracts, potentially adding to open interest or forcing immediate delivery demand. But more importantly, February 24th is the day Shanghai reopens after the Chinese New Year holiday closure. Right now, Shanghai has been dark since President's Day. U.S. markets were closed for the holiday. That created an 8 to 9 day window where Eastern physical market pressure was lifted entirely. During that window, Western paper markets could move with far less resistance because the physical anchor provided by Shanghai demand was temporarily removed. But on February 24th, Shanghai comes back online. And when it does, one of 2 things will happen. Either the $12 to $20 physical premium compresses because Western paper prices rise to meet Eastern physical demand, or the premium explodes even wider because Eastern buyers come back into the market aggressively and Western paper prices remain suppressed. The direction of that move will tell us everything about whether the paper market still has control or whether physical reality is about to overwhelm it. February 27th, first notice day. This is the moment of reckoning. 58,770 contracts. 294 million ounces of paper exposure. Whatever percentage of that open interest decides to stand for physical delivery will determine whether the COMEX faces a manageable delivery cycle or a structural crisis. If delivery demand comes in at historical norms, the system survives. If it comes in at the elevated rates we've been seeing recently, or higher, the exchange faces a genuine test of its ability to deliver physical metal at paper prices. 3 expiries, 3 critical dates, all converging in a single week. And all of this is happening while implied volatility is 10 points higher at 74 than it was at 121, signaling that the options market believes something explosive is coming. $64 trillion by 2036, big tech CDS surges 400%. Iran at Hormuz. Now let's zoom out and look at the macro environment in which all of this is happening. And right now, every major systemic stress indicator is flashing red. U.S. debt trajectory. The United States is currently on track to add $2.4 trillion per year to the national debt. Annual interest costs on that debt are projected to hit $2.1 trillion. The U.S. government is projected to be paying $2.1 trillion per year, more than Social Security, more than Medicare. And when sovereign debt reaches these levels, historically, governments have only two choices: default or inflate. The United States will not default on dollar-denominated debt, and inflation is exactly what drives real money, gold and silver, higher. Big tech credit, default swap, explosion. In the past 13 months, credit default swap exposure on major technology companies has surged from $2.2 billion to $10 billion. That is a 400% increase, is now showing up in the derivatives market as default risk. The credit markets are pricing in the possibility that some of the largest, most systemically important technology companies could face financial distress. This is not speculative fringe analysis. IOCAS, telling you that something is wrong in the foundation of the so-called Magnificent Seven tech trade that has powered equity markets for years. Iran conducting missile drills at the Strait of Hormuz. While nuclear negotiations continue in the Strait of Hormuz, the narrow choke point through which 20% of global oil supply flows every single day, which cascades into inflation, which destabilizes bond markets. The geopolitical risk layer is not hypothetical, and it is happening in the single most important energy choke point on the planet. Bitcoin ETF outflows. For 4 consecutive weeks, Bitcoin ETFs have seen net outflows. This is significant because Bitcoin has been marketed as digital gold and a hedge against fiat currency debasement. If institutional money is rotating out of Bitcoin, the question is, where is it going? Some of it is going to cash, some is going to bonds. The original hard money that has survived every currency collapse in human history. Why the system is fracturing in real time. The paper silver market and the physical silver market are no longer pricing the same asset. They have diverged so significantly that they now represent two entirely different realities. In the paper market, silver is $74. Futures contracts trade at that price. Options are written at that price. But in the physical market, where actual metal changes hands and industrial buyers need supply for manufacturing, silver is trading near $100. That is a 35% divergence. That is a fracture. And the behavior of industrial buyers confirms that the fracture is real. When Samsung, one of the largest electronics manufacturers on the planet, bypasses the futures exchange and calls a mine CEO directly to secure supply, that tells you the exchange price is not the real price. When buyers are willing to pay 20% premiums above spot just to guarantee delivery, that tells you the paper price has lost credibility as a mechanism for price discovery. Now add in the volatility signal. Implied volatility should be collapsing after a 40% drawdown. Instead, it is 10 points higher at current lows than it was at the $121 peak. That is the options market telling you that professional traders believe the move is not over. That, in fact, the most violent part of the move may still be ahead. When volatility spikes at lows rather than at highs, it typically signals that a major reversal or capitulation event is coming. Either paper prices are about to catch up to physical reality, or physical supply is about to fail to meet paper demand. The system has been built on the assumption that the vast majority of futures contracts never stand for delivery. That assumption is being tested right now. Open interest remains elevated 8 days before first notice day. Delivery rates have been running at double historical norms, and physical premiums are at levels that suggest industrial buyers believe they cannot rely on exchange pricing anymore. If even 15 to 20% of current open interest stands for delivery, the COMEX faces a structural challenge that cannot be resolved by printing more paper contracts. You cannot deliver paper to a buyer who wants metal. And right now, the physical market is signaling that more and more buyers want metal. Not exposure, not a cash-settled contract, but actual silver they can hold. Acknowledging both sides of the trade, let's be intellectually honest about both scenarios, because risk management requires acknowledging the full range of possible outcomes, not just the outcome you want to see. The bear case is straightforward and should not be dismissed. Paper markets remain dominant in the short term. The 40% technical damage from $120 to $74 is real and substantial. Historical delivery averages remain low at around 5%, which would make even current elevated open interest manageable for the COMEX. Risk-off environments, where investors flee to cash and sell everything including precious metals, can and do liquidate metals alongside equities. We saw it in March 2020, and we could see it again if a credit event or recession triggers mass deleveraging. The paper market has tools. They can raise margin requirements. They can incentivize cash settlements. They can manage delivery demand through procedural mechanisms that discourage physical delivery. And they have done this successfully for decades. The system is designed to survive stress, and it has institutional support from central banks, bullion banks, and exchanges that have every incentive to keep it functional. The bull case, however, rests on a convergence of factors that we have not seen simultaneously in modern market history. You have a 20% sustained physical premium that industrial buyers are paying. You have direct supply deals being executed outside of exchange pricing. You have elevated open interest 8 days before first notice day with no mass rollover. You have implied volatility spiking at lows rather than collapsing. You have 3 critical expiry dates converging in a single week. You have Shanghai reopening on February 24th, which will either compress the premium or explode it wider. You have a U.S. debt trajectory heading towards $64 trillion. You have big tech CDS exposure up 400%. You have Iran conducting missile drills at the Strait of Hormuz. And you have Bitcoin ETFs seeing 4 straight weeks of outflows, suggesting institutional money is rotating somewhere. If physical delivery demand hits 15 to 20% of open interest in this environment, the COMEX faces a genuine test. Not a collapse, but a test. And the outcome of that test will determine whether the paper-driven pricing mechanism for silver can continue to suppress physical reality, or whether physical reality is about to reassert itself in a way that cannot be papered over. How to know what's really happening in real time. So what do you actually watch between now and February 27th to understand whether this is just another volatility spike or the beginning of something structural? First, watch the physical premium. On February 24th, Shanghai reopens. If the $12 to $20 premium compresses significantly, meaning physical prices fall toward paper prices, that suggests Western paper markets are still in control and the divergence was temporary. But if the premium holds or widens, that is confirmation that physical buyers do not accept paper pricing and are willing to continue paying massive premiums for real metal. Second, watch COMEX registered inventory. If inventory starts moving lower, if physical silver begins leaving the vaults, that is confirmation that delivery demand is real and being fulfilled. If inventory holds flat or rises, it suggests the paper mechanism is containing the pressure through cash settlements and rollovers. Third, watch the delivery percentage after first notice day. Historical average, 5%. Recent trend, 10 to 13%. If the number comes in above 15% in the current environment, that is unprecedented. If it comes in above 20%, that is historic and potentially destabilizing for the exchange's ability to deliver at paper prices. Fourth, watch implied volatility. If IV continues to spike at current depressed prices, it confirms that the options market is pricing an explosive move. If IV collapses, it suggests the fear trade is over and the market is stabilizing. Fifth, watch for coordinated narratives. If mainstream financial media begins publishing bearish silver headlines during this 8-day window that coincide precisely with price drops, you will know that narrative is being deployed strategically. Pattern recognition matters. If the timing is too perfect, it's not an accident. 8 days, 294 million ounces. One question. Here's what this all comes down to. The paper silver market and the physical silver market are telling 2 completely different stories. Paper says $74. Physical says near $100. Paper says manageable open interest. Physical says industrial buyers are bypassing exchanges and paying 20% premiums. Paper says volatility should be falling after a 40% crash. Physical says the options market is pricing an explosive reversal. In 8 trading days, on February 27th, the COMEX will face a test. 58,770 contracts representing 294 million ounces of paper silver will either roll, close, or stand for delivery. If delivery demand comes in at historical norms, the system survives and the paper market retains control. If delivery demand comes in at elevated recent rates, 10, 15, or 20%, the exchange faces a structural challenge that cannot be resolved by printing more contracts. This is not just about one delivery cycle. This is about whether the paper-driven pricing mechanism that has governed precious metals markets for decades can continue to function when physical buyers refuse to accept paper prices. It is about whether industrial demand for silver, driven by the energy transition, electrification, 5G, AI infrastructure, and defense technology, can be suppressed indefinitely by futures market manipulation. And it is about whether the systemic macro stress that is building in sovereign debt markets, corporate credit markets, and geopolitical flashpoints will finally force investors back into the oldest form of money that exists, physical gold and physical silver. The United States is heading towards $64 trillion in debt and $2.1 trillion in annual interest costs. Big tech credit default swaps have surged 400% in 13 months. Iran is conducting missile drills at the Strait of Hormuz, where 20% of global oil flows. Bitcoin ETFs are seeing consistent outflows. And silver, down 40% from its January peak, is now trading with implied volatility 10 points higher than it had at the top. Markets are closed, Shanghai is out, the 8-day window is open. February 20th, SLV options expiry. February 24th, Silver American options expiry and Shanghai reopens. February 27th, first notice day. Watch the premiums, watch the inventory, watch the delivery rates, and understand that in the market, for real money, the most important price is never the one on your screen. It is the price at which someone will actually deliver metal into your hand. This is the moment. Either the paper system reasserts control and the divergence closes, or physical reality overwhelms the paper mechanism, and we enter a new phase in precious metals markets where industrial demand, sovereign accumulation, and delivery stress rewrite the rules entirely.